Hey everybody, Smart Silver Stacker here. And if you've been paying attention to the markets over the past 24 hours, you've probably noticed that there has been a pretty significant pullback in the price of gold and also of silver, and also in stocks pretty much across the board. And this all started yesterday when Jerome Powell gave a speech at the IMF that is being characterized as very hawkish. Now, personally, I think that this pullback in the metals and also probably just in markets as a whole is really more of a buying opportunity than anything else. Even if it does persist for a little bit longer, I don't think that prices will remain lower for long because I don't think that Jerome Powell is really nearly as much of a hawk as he is being portrayed as. And that's what we're going to talk about in today's video, so let's get to it. Today's video is brought to you by Silver Botanicals, household and personal hygiene products that utilize the power of nano silver. Head over to silverbotanicals.com today. There's a link down in the description. And don't forget to use coupon code STACKER to save 10% off your order. Okay, so you can see that the pullback in asset prices is still pretty much in effect today. NASDAQ slightly in the green, but the other major stock indexes are all in the red. Crude oil in the red. Gold and silver in the red, silver especially almost down back to 24 bucks. So that's a pretty big hit. We were over $26 this week. And this pullback in asset prices did begin yesterday when Jerome Powell at a speech at the IMF indicated that a half point or 50 basis point increase in the federal funds rate could be in store at the Fed meeting that is coming up in 2 weeks in May. But I am here to tell you that Jerome Powell is not being a hawk by raising the federal funds rate by 50 basis points. Inflation is over 8.5% year over year. And that, of course, is according to the CPI, which I think we're all aware understates real inflation to a significant extent. You know, if you were to use the same CPI that we were using back in the 80s, which is, what everybody wants to talk about now, we have the highest inflation since the 80s. But if we were using the same CPI calculations that we used back then, inflation now would actually be significantly higher than it ever got in the 1980s. So in reality, we have currently the worst inflation since the U.S. was taken off the gold standard back in 1971 by good old Richard Nixon. And, a 50 basis point increase in the federal funds rate is not going to do anything to tame inflation that is over 8.5%. So if they go through with this 50 basis point increase at their next meeting, we're going to have a Fed funds rate that's still under 1%. And so that means that in real terms, we still have negative rates of almost 8%. So how that is supposed to tame inflation is beyond me. Even with a 1 or 2 or 3 or 4 or 5% federal funds rate, we still essentially have an extremely accommodative monetary policy because real rates are negative. I mean, if the Fed wants to get inflation under control, they are going to have to raise rates higher than the level of inflation. I mean, that's what Paul Volcker had to do back in 1979. He had to crank up the federal funds rate to almost 20% to deal with this kind of inflation. And I really just don't think that there's any way that this increase is going to do anything meaningfully to get inflation under control. However, we have seen that the markets obviously are addicted to this easy money policy that the Fed has had in place for so long, because just the mere mention of raising interest rates by 0.5% has caused this big pullback in asset prices. I think that inflation is probably going to continue getting a lot worse. It was just a couple weeks ago that we got this producer price index that was over 11%. And that is a measure of prices that wholesalers are having to pay. So, this kind of throws a wrench in that whole narrative of the current administration that inflation is a result of greedy businesses ratcheting up prices. They're always looking for scapegoats for inflation. It's either going to be Vladimir Putin or greedy businesses. They never want to look at the real cause, which of course is the excessively accommodative monetary policy that the Fed has had in place for so long. I mean, that is really the only way you can get inflation like we're having, is you expand the money supply. Of course, the president likes to blame businesses. It wasn't that long ago that he was blaming meat packers for the increase in meat prices. And I'm sure we'll see more of that as inflation continues to worsen. Clearly, what this producer price index shows us is that businesses actually have not passed on the full cost of inflation to consumers yet. Maybe they're hoping that inflation would abate. Maybe they were hoping it was transitory like the Fed claimed. Businesses don't want to raise prices because that means that they may lose market share. They may not be as competitive. But moving forward, they are going to eventually be forced to pass these costs on to consumers. And that's why I think that maybe for April, we may see the CPI go into double digits. When we get the numbers for April, we may see that the year-over-year inflation rate is over 10%. The real problem is that we do still have this extremely accommodative monetary policy, and I don't think that's going to change anytime soon because, if Jerome Powell were to actually become a hawk, because, this headline here from Reuters, they're saying this is a hawkish pivot. Well, I don't think that it's really fair to call this guy a hawk at this point. But if he were to ever actually become a true hawk, kind of in the way that Paul Volcker was back in the 70s, it would completely eviscerate the asset bubbles that we've seen inflated over the past 2 years. Markets would come crashing down, prices across the board would come crashing down, and that would undermine the entire narrative of an economic recovery that we've heard, because that is all, of course, based on the recovery of the stock market, the inflation of asset bubbles like stocks, like housing. And there's no way that there's going to be any political will for that. So, this is not a hawkish move in my view. If all of this talk of raising interest rates, if the quantitative tightening that we've got coming in May, the shrinking of the Fed balance sheet, when they start to sell treasuries and mortgage-backed securities back into the market, and they start basically being a competitor of the Treasury trying to sell these debt instruments, if that causes a spike up in Treasury yields, or if we see a big drop in stocks or a big correction, I think that the Fed will absolutely reverse course, and they will revert to cutting interest rates. They will revert to quantitative easing, and they will begin buying assets up again in a big way. And so all of these dips, on this quote unquote hawkish talk that we're getting, I think that they should just be viewed as buying opportunities. Now, could gold and silver pull back more? Of course. They absolutely could. But the only scenario I see where we see a major pullback in the price of gold and silver is if we get some kind of a broad decline, some kind of a black swan event triggers a massive sell-off in stocks and other assets. And yeah, gold and silver will probably drop along with that. But if something like that occurs, that will simply be a buying opportunity, a massive buying opportunity, kind of like what we saw back in March of 2020, because the Fed is going to come out printing presses blazing, I'm sure, in response to any event like that. And there's just no way that they're going to allow asset prices to drop in a meaningful way. Now, asset prices may drop in real terms because I think inflation is going to continue moving much higher as we go forward. Even though their price in dollars may increase, the value of the dollar may drop significantly. Lately we've seen an increase in the US dollar index, but I think that probably is going to be short-lived. That possibly is a result of all the geopolitical tension that we've seen as a result of the Russia-Ukraine conflict. But I think as people begin to realize that there's no way the Fed is going to get inflation under control with this kind of a plan, that the strength of the dollar index is going to begin to turn into weakness, and that's when we're really going to see gold and silver take off. So I'm still stacking silver. I'm still stacking gold. I view this as a buying opportunity. An important thing to note here is even though we've seen gold drop down to around $1,930, the price of a 1-ounce gold coin still well over $2,000. If you want to buy a silver eagle, you're still going to be paying well over $35. So it's not like the price of physical gold or silver has really dropped that much. It's mostly drops in the paper price. Although, you can pick up a gold coin cheaper now than you could a couple days ago, and you can pick up a silver coin cheaper than you could a couple days ago. I'm probably going to be shopping around this weekend and seeing what I can find. Maybe some platinum. I don't have a lot of platinum in my stack, and I think that right now platinum is actually significantly undervalued relative to both gold and silver. So I might be shopping around for some of that this weekend. We'll see. But that's just what I'm doing. None of this is financial advice. But let me know what you think. Do you think that Jerome Powell now with his half of 1 point interest rate has turned into a major hawk, or is all of this just the market getting this wrong? I'd love to know what you have to say, so let me know in the comments below. And if you enjoyed this video and you'd like to see more like it, then check out the videos that are popping up on your screen right now. And I will catch all of you next time. Thank you all very much for watching. Smart Silver Stacker, out.